Namaskar. I'm Ashok Vyas. Welcome to the 20th episode of Money and Prosperity. Being program director with ITV and owner of Insight for Creativity, it's my privilege to be sitting and talking to someone who's going to enlighten us on money and prosperity. And these are the days when it is even more important to sit with Paresh Shah. We are in the middle of tax season. Dreaded tax bill is around, and however, this hurts retirees the most. In today's episode, we will discuss taxation of retirement income with Pareshji, who is the managing principal of Paresh Shah Partners LLC. He is a certified financial planner and wealth strategist for the last 22 years, and he has helped individuals and businesses co-create innovative financial strategies. Pareshji is a licensed CPE presenter. He has educated CPAs as they guide their clients on investments, life, disability, and long-term care insurance. He specializes in pension planning, profit-sharing plans, asset protection, estate planning, and business succession planning. So much to learn from him. Pareshji graduated as a chemical engineer. He is an honors graduate from prestigious Indian Institute of Technology at Kharagpur, India. He is a 2016 honoree for Long Island Business News Leaders in Diversity Awards. He resides in the town of Hicksville in Long Island with his wife Shimul and son Shramik. It's with great pleasure that I welcome once again Pareshji to our studio.
Namaskar, Ashokji. Thank you so much for such a warm welcome as usual. Really appreciate it.
Pareshji, introduction is related to the warmth that a personality brings to the room or to the table. But what is important on the table today, Pareshji, is something related to tax. And there are some confusions with respect to we earn, we pay our taxes, and then we also contribute to Social Security and Medicare.
Right.
Now, generally people think that Social Security income is not taxed while you retire. Is that correct?
First of all, Ashokji, let me make a small disclaimer. I'm not a CPA or an enrolled agent, so I'm not giving any tax advice here, but from a financial planner's perspective, it is very important to understand how every element of your income or your growth is taxed, because that really affects your rate of return or how much money you're going to have in your retirement, etc. So with that perspective in mind, we have studied the taxation of Social Security income pretty strongly, and that's what I'm going to share with you on the episode today. It is a very widely held belief that your Social Security, when you start collecting it, that is not going to be taxed, because it is, when you, let's say you make $50,000 of income, then each paycheck, let's say, is $5,000. Automatically from the $5,000, our 7.5% is cut for Social Security, and the employer also adds his match, and that goes to the kitty. So we feel that on gross income, we are paying this money already. Why does it need to be taxed again?
Absolutely.
Yeah. So, but that is not the case. The government, what is doing with Social Security really is that they're taking the money, they're pooling it together, they're putting it to grow, and then at a certain age, they're going to start distributing it to every person as income for life. So with that particular concept of Social Security, where it becomes a mechanism whereby the government will pay you money as an income in retirement, then we look at it as an income perspective at that time. And then certain rules apply whereby Social Security income could be taxed. So it's not just that it cannot be taxed, it could be taxed also,
So that is a little bit surprising for many who kind of thought that Social Security has nothing to do with further tax, because somehow the psychological concept that laymen carry in their mind is this is going to be tax-free, because after all it's happening after retirement. But now tell me a little bit about how the tax structure relates to Social Security income. I know you are not a tax planner yet, something as a financial professional.
Do you remember we used to watch this detective serial by Columbo. There was a detective Columbo. He used to be very untidy and not well kept and all. But what he would do is the bad guy would be there and he would approach him and then you'd start asking him questions and all kinds of stupid questions he'd ask. Some useless questions, and everyone is thinking that this person who's committed this crime is going to get away. Then he's going away, and then he turns around. Always he usually turns around and says, "Oh, one more question." And when he asks that one question, the bad guy knows that he's caught. This is Columbo has been on him all the time and has realized how he's committed the crime, knows where the proof is, etc. So in that way, when you are earning social security income, normally we do our taxes, we'd give all our income numbers and our W-2s and our deductions and everything. We would give those deduct to the CPA or even put it into some kind of software. And eventually the tax would be spit out, that this is the amount of tax that you have to pay.
Correct.
But then when you are getting social security income, you have to do one more calculation, the Columbo calculation as I like to call it. And there is a term used which is not known to many people. It's called provisional income. Okay? So once you are in the mode where you are receiving social security, you have to do a calculation of provisional income and then backtrack that into your taxes for the purpose of social security. I know it's a little complex, but yet I'd like to take a few moments to explain what is provisional income. So provisional income, normally when we have income, we have earned income, which is our income from salary, and then we have some favored income by capital gain or dividends, which are taxed at a different rate. But when you are doing, and then there is something income from what is called municipal bonds, which are completely income tax free. There are 2-3 different ways in which you can get income. When it comes to calculation of provisional income, all your earned income, all the distribution that you get from pension, all the distribution that you get from your IRAs and 401ks and those type of accounts, your interest on municipal bonds, your rental income, everything is added together. And then on top of it, 50% of your social security income is added. Now they come to that number. That number could be 5,000, 10,000, 25,000. It could be whatever. It could be 100,000. When they take that number, then they determine based on that provisional income number whether social security income that you have received is taxable or not. So provisional income calculation then kind of backtracks into whether social security income is taxable or not. Does that make sense?
So I think I got lost somewhere, but it's not surprising. It's not easy to understand tax, and then these terms come up, provisional income, and then you start thinking at the back of your mind how it is going to relate to me. So I remember you mentioned about some limit somewhere. So what these limits are? If you explain a little bit more, connecting with
Yes, with the
context here.
So as I told you, see, normally when we go, we just do the calculation of our income and we put it on the tax return. But now we have to do this one more form called provisional income. And I explained how provisional income is calculated. I understand it's complex and that you really need to sit down with a professional in order to be able to do it. But then we go back and we see that, let's say that the provisional income that you have, you're filing as a single person. If your provisional income is less than $25,000, then the Social Security is not taxed. If your provisional income is as a married filing jointly is below 32,000, then you do not pay tax on your Social Security income. And please note that.
Yeah.
So that as a husband and wife, if you're earning from rental income, earned income, from every other source of income, let's say you're earning $10,000 and then you're earning $30,000 as Social Security. So 10,000 plus 50% of Social Security, that is $25,000. So you're below the $32,000 mark. Then, and I'm oversimplifying this,
Correct.
Please understand that. So then you're not paying any tax. Correct? You're not paying any tax on your Social Security income. However, these limits are so low that most people are going to fall in the bracket where they're going to pay tax on
Right.
social.
So now the next question would be, what happens if you are above that?
Well, if you're above that, then there is a method to calculate that. I'm going to explain that, but please note that it is very complex. And like with everything with IRS, they've made it complex deliberately. But I'm going to try to explain as far as possible for the benefit of our viewers. Once again, I want to very strongly recommend that do not try to do this at home. This is not a calculation to be done by the layman. Most professionals do it, but even now, most professionals rely on some very complex software to be able to plug in the numbers and do it. So, if your income, if you're married filing jointly, if your income is between 32,000 and 44,000, then you pay tax on 50% of your social security. And if your income is above 44,000, then you pay tax on 85% of your social security income. Now, whenever I've said that, there is a confusion. People think that, oh, if my income is more than 32,000 and less than 44,000, then if I'm getting 10,000 as social security income, 5,000 is I'm going to pay taxes. It's not 50% is not the tax. 50% is taken as income tax. So 50% becomes tax. I know you're getting confused, but just flow with me, please, because this is a little complex part of the law. I'm going to go with an example. Let us say that your income, provisional income is say $60,000 and your social security income is $30,000, right? So 60 plus half of social security is $15,000, so $75,000. So you have to pay tax on 85% of your social security income. Now, 85% of 30,000 is 25,500. So what is done is on your income, 25,500 is added on top and you pay tax on it. Let's say your tax is 20%, your tax will be about $5,100. So on your $30,000, you paid $5,100 as tax on your social security. Again, Ashokji, these are all very general numbers.
But even these general numbers, if I may say as a layman, they are a little scary. You think that I will be paying so much taxes and it's not even a lot of money that you have. So if I may request you to, because this is your forte and now you cannot say that, no, I'm not a tax planner. So as a financial planner, why do you think this is so important to learn about all this and keep this into mind?
Yeah. I personally feel that there is, if we recognize that income is going to be taxable during your retirement years, right? Then your social security is going to be taxable. Then you know that the amount of money that you expect is not the amount of money that is going to come into your hands, right? So if you're expecting that I'm going to get $30,000 from Social Security and my wife is going to get $30,000 from Social Security, between the two of us we'll get 60,000. It won't be taxed at $5,000 a month. Now I don't have mortgage or any children's responsibility or anything. I should be fine. That's how you think about things, right? But then you think that, no, you know what, there is going to be a tax element. Now just now we calculated the tax on this could be about $10,000, $5,100 for each person, $10,000. So now we're down $10,000 on the income. So you're left with, instead of having $5,000 a month as income, you're left with say $4,000 a month, or even less than that actually, $3,500 a month. That can completely make or break a person, the retirement planning. So it is very important to understand what is going to get affected. We take that into consideration when we are saying that, okay, the person A is there and person A is allocating this money to his IRA account, or this much is going to be his pension income. Then we need to take into account what is going to be the tax level so that the net cash in hand is calculated, determined, and based on that planning can be established, because otherwise you could go completely wrong in your numbers, you know.
Absolutely. So I appreciate that you are helping us stay right on our numbers, and it is important how much money you actually have in hand after deductions of all kind, including these tax deductions, which we many times do not even consider that are going to be there. There are so many things that we would like to learn from you, Pariji, but as something that I learned from you also is punctuality or respect for time, because time is money, they say. And maybe we'll keep some of the questions for the next episode. But one number which I would like to share with our viewers is phone number of this gentleman. 516-268-3446 is the number where you can reach Paresh Shah, or you can write to him pshah@pareshah, PARESHAH.com. And indeed, it's sometimes even more important that we get correct, exact and specific information to move ahead without getting hurt, especially in the financial field. Paresh, thank you very much for helping us out.
You,
and we'll continue next week in another episode of Money and Prosperity with Paresh. Thanks for being with us. This is Ashok Vyas.